There's been three major stock market crashes or corrections in my lifetime, starting with the dot-com bubble of 2001. I was about 4 years old at the time. And then the great financial crisis of 2008. And now whatever we're calling what happened in 2022. A lot of retail investors, understandably, are extremely afraid of bear markets, fearing that the market will never recover, which is kind of an irrational fear since that's never happened. Or they're afraid that the market will drop for X amount of months or even years, like we saw from 2000 to 2003. Or another concern is that the market will have little to no growth whatsoever for a few years and trade flat for a long period of time, meaning you invest $1,000 into the market today and 2 years or so go by, and by the end of those 2 years, your total investment ends up being $1,001. And this is actually something that happened from 2014 to 2016. So these are all legitimate concerns, especially if you're putting a good chunk of your money into the market and you don't like opening your account and seeing it down 20, 30, 40%, or for some people down 99%. And I think a huge reason why younger retail investors might be so fearful is because they're probably putting too much into the market or too much into certain stocks. And they start to panic when the market drops because maybe they were planning on making a profit in the short term and they actually need that money to use for bills or things they really need. And I'm guilty of this too, so I consistently add money into my investing account every month. I use Robinhood, so nothing too special. And sometimes I think if I can make X amount in gains within a certain amount of time, I can sell a chunk of that and use it as a down payment for a house or a car or something. And so that mindset is going against the fundamentals of investing. You have to make sure that you're not conflating your savings account with your investing account. Those two aren't supposed to be the same thing. So the point of all this is that, as we know, the market fluctuates in the short term and sometimes we slip into a bear market, but this is actually something that's not only completely normal for markets, but can actually be a good thing, especially if you're not retiring anytime soon. The stock market and the general macro economy are cyclical, meaning that they're constantly going through cycles of either fast growth, slow growth, or negative growth. And every time there's a period of extreme growth in the stock market, it's almost always a guarantee that it will fall back down to more rational levels within a fairly short amount of time as well. Looking at the S&P 500, we saw this in the late 1990s. In just a few years, the market pumped up to overvalued prices, and PE ratios for tech stocks at the time were astronomical. And then, as we know, they came dropping back down for those 3 years or so. And then the same thing happened in 2020 when interest rates were slashed. Prices rose quickly and significantly high for 2 years in a row, and now have come back down as we've seen the past 13 months or so. And that's just what the market does. It goes through those short-term cycles where it seems like the market is heading towards rock bottom, especially if you're watching the financial news. So kind of the way to combat this is by using your, what I call investing superpower. And it's by being extremely consistent and diligent about putting money into the market, no matter what the market is doing, for as long as you possibly can. And as you're doing this and the market happens to dip down 20 or 30%, it's providing you with a 12-month or 18-month long opportunity to buy at low prices. So ultimately, when the market does eventually recover, your returns will end up being really big. But again, this works best if you're buying into the market frequently every month or every other month, and dollar cost averaging basically until you retire. What's important though too is in order for this to actually work, you need to be buying into the right companies and picking the right stocks. You definitely don't want to be buying speculative, overly hyped stocks or meme stocks, or even stocks of companies that lie about their products. It needs to be in profitable, sustainable businesses that are consistently growing and adding value to the US economy. And if you don't want to pick stocks or do research on specific companies, there's a bunch of different ETFs that track the market directly that are low cost and pay a dividend as well. And I won't go over which ETFs, there's a lot of them that I can think of, but I have made a couple videos on the specific ETFs that I like to invest in. So if you're buying into these stocks and ETFs on a frequent schedule every month or every other month, and you do that every single time like clockwork, over the long term, you'll be able to grow your account to an amount that allows you to retire, and the more you're able to add each month, the sooner you'll hit that retirement number. So those are just my thoughts on kind of the state of the market right now and whether or not it's worth it to invest right now. And the answer to that, in my opinion, is yes. Right now is one of the best times to invest in the stock market, especially if you're dollar cost averaging rather than putting it all in at once. Thanks for watching. I'll see you later.